The Organization for Economic Cooperation and Development, OECD, that's an intergovernmental body with 38 member countries, has released its latest economic report. The body warns of an increasingly challenging global outlook with substantial increases in trade barriers, tighter financial conditions, weakened business and consumer confidence, and elevated policy uncertainty, all posing significant risks to growth. In addition, investments have been weak, inflation unconquered, as they plead for ways of addressing concerns with an imperfect global trading system, but doing this in a collaborative manner to avoid the negative growth outcomes. Hello, welcome back to Global Business Insights, where we took a closer look at the main business headlines moving markets all over the world. The deep dive today is on a global economic slowdown that is unfolding before us. As we approach the middle of the year, global economic growth is looking sluggish, and the data is providing the evidence. The dollar is flirting with a 3-year low, and US government bonds are under pressure. On Monday, we got poor US factory PMI readings. The US ISM factory PMI data came in at 48.5. That was for May, adding more pressure to already a weak dollar momentum. But we are also still getting the resilience narrative, as President of the Federal Reserve Bank of Dallas, Lori Logan, said on Monday that despite the uncertainty and financial market volatility, the U.S. economy is resilient and the labor market remains stable. More clues on that on Friday when we get the U.S. jobs report. It's not just the U.S. Earlier in the week, we got manufacturing PMIs in Asia lingering in contraction. Analysts say it's hard to expect a pickup in Asia's manufacturing activity anytime soon, burdened with the quite high reciprocal tariffs. China's official manufacturing purchasing managers index rose to 49.5 compared to 49.0 in April. The NBS non-manufacturing PMI eased to 50.3 in May versus April's 50.4 figure, but still below the estimates of 50.6. The Shixin S&P Global Manufacturing PMI, that's a private sector metric, came in at 48.3, dropping sharply from 50.4 in April. It's all contraction. The Jibun Bank Japan Manufacturing PMI was revised higher to 49.4 in May 2025 from 49.0 in the preliminary estimate, better than 48.7 in the previous month. The decline in new orders eased, but worries over US tariffs have dampened the recovery from an almost year-long contraction. We also reported on Monday that May PMI for Germany remained in contraction for the 35th month. Eurozone data also lingered in contraction, but with Greece and Spain beginning to post expansions. UK manufacturing PMI rose to a 3-month high of 46.4 in May, up from 45.4 in April, as it continues to report downturns in output, new orders, and new export business staying subdued. In Nigeria, May PMI was 52.7 in May, the 6th successive month of expansion, and signaling a solid strengthening of business conditions over the month. But the Economic Activity Index is down from 54.2 in April, with a slowdown seen across both output and new orders due to still elevated inflationary pressures. Stanbic IBTC analysts still expect the economy to grow by 3.5% year-on-year in real terms in 2025, relative to 3.4% year-on-year growth in 2024. We are seeing a somewhat unusual, almost simultaneous slowdown in PMIs, possibly an early signal of disappointing Q2 GDP growth print. The deep dive today is about the unfolding decline in global economic growth and what that could mean. We are not seeing stock prices falling off the cliff yet, but valuations seem to be mired in a trading range as analysts await clarity, not just on US tariffs, but what the broader protectionism and geopolitical complexities that are unfolding before us, what they could all mean. According to Alvaro Pereira, OECD chief economist, he says in a report out yesterday that there is a significant increase in trade barriers as well as in economic and trade policy uncertainty. The OECD now see global growth falling from 3.3% in 2024 to a modest 2.9% in 2025 and in 2026. Adding that weakened economic prospects will be felt around the world with almost no exception. The US is forecast to grow just 1.6% this year, down from 3.3% in 2024, as it pursues more protectionist policies. The OECD reports say that for countries more affected by tariffs, inflation might even rise first before coming down. I have a somewhat different take. Looking at the data, the global economy has been in decline for a while as productivity struggled pre-2007. Markets oddly responded with inflated asset prices until we had the first shock in the 2007 economic slump, when the US housing market crashed and large amounts of mortgage-backed securities and derivatives plummeted in value. Following that was the pandemic shock that we saw in 2020, which led to a debt-propelled recovery, which is still a huge burden for most economies and continues to weigh on growth. As growth becomes more tepid, the response to the lull was a different rise in nationalism and a more aggressive protectionism. Global economies are starved of new drivers of growth as we see the typical drivers looking somewhat spent. For example, monetization of innovation is much slower, held back by more suspicious regulation. The era of cheap exploitation of resource-rich, gullible developing economies or cheap labor from India, Malaysia, or China is getting over. We see more indebted governments after COVID support eroded fiscal space, and the debt-propelled global growth post-COVID was unsustainable. The inevitable outcome is slowdown that the World Bank, IMF, and OECD have been flagging for a while. The answer, according to Bretton Woods institutions, is more global and fairer collaboration, but that recipe does not ring well to the politics as inequality rapidly expanded and the present economic order is intensely distrusted. The rise of nationalism today in the US, Poland, in the UK is not just a Trump problem. It's a natural everyone for himself response as hardships bite. Protectionism can only be arrested by new drivers of fairer economic well-being. Don't hold your breath. The big new hope, AI technology-driven growth, is exciting as advanced countries are ramping up AI infrastructure aggressively and investments are magnetized to this new wave. But this may lead to another expansion of the gap between rich and poorer nations, which fuels more immigration, distrust, instability, and again reinforces the cycle of protectionism. Let me wrap up. Countries need to understand what is happening, especially Africa. Investor dollars are now more difficult to attract and very suspicious of extreme nationalism. According to the World Trade Organization boss, Madam Okojo-Iweala, developing economies are hit the hardest in a protectionist environment. In South Africa, consumer confidence is falling. OECD report now projects GDP growth to be coming at 1.3% in 2025 and 1.4% in 2026, with high uncertainty and declining confidence weighing more on domestic demand. And of course, the increase in tariffs also weighing on exports. Just yesterday, South Africa's economy grew a sluggish 0.1% in the first quarter of 2025. First quarter, South Africa GDP growth increased year-on-year 0.8%. Put plainly, South Africa just needs to do better building on the most developed infrastructure in the continent And in Egypt, the headline May S&P Global Egypt Purchasing Managers Index rose to 49.5 from 48.5 in April, showing a softer contraction. The world is looking for new answers to the slowdown. Advanced countries are rethinking old narratives. The flux definitely is inevitable, and Africa needs a proactive response, which includes fast-tracking continental integration to avoid being harvested afresh by the agenda of other regions, eyeing its untapped massive potential. Self-sufficiency is part of the solution as more value is added locally to create jobs, but you could get a blowback from unmanaged protectionism. You typically can get away with protectionism and nationalism in, say, an India if there are other overriding attractiveness factors such as abundance of skills, macroeconomic stability, ease of doing business, and so on, size of the market. Already, the private sector in Africa could be at the cusp of a different revival, especially as venture capital picks up and even as tech infrastructure improves and governments incentivize boosting productivity and investments. But the next global growth catalyst is far from being a sure bet, whether it comes from Africa, China, or artificial intelligence-driven technology in the US. The more intentional wave will have the edge. More business stories. Eurozone inflation fell to 1.9%, below the European Central Bank's 2% target in May for the first time in 7 months, and helping the case for further interest rate cuts this year. Services inflation print also cooled significantly to 3.2% last month. Meta signed a 20-year agreement to buy nuclear power from Constellation Energy beginning in 2027. The tech giant is buying about 1.1 gigawatts of power from Constellation's Clean Energy Center in Illinois. Elon Musk, in his latest update for X, has announced XChat, a new encrypted messaging feature that will support audio and video calls without a phone number. It also provides for vanishing messages and all file sharing. President Trump and Chinese President Xi Jinping are said to be planning to meet this week after a series of flare-ups between Washington and Beijing that looked set to derail a tentative trade deal. Livestock Development Minister Idi Maiha said on Monday, that's in Nigeria, that Nigeria is importing dairy cattle from Denmark as it aims to double milk output within 5 years as part of a plan to cut dairy imports that cost the country $1.5 billion a year. Nigeria's milk output of 700,000 tons a year lags its annual consumption of 1.6 million tons. Nvidia passed Microsoft in market cap, once again becoming the most valuable publicly traded company in the world. Artificial intelligence is fueling market optimism as Wall Street closed up, plus also a better than expected jobs opening report and expectation that a pro-business tax bill could give corporate America a boost. Trump has asked for more DOGE cuts to be embedded in the bill to reduce deficits, even as Musk says mammoth spending is bankrupting the country. On the economy, some good news as the Atlanta Fed expects Q2 GDP to grow by 4.6%. This morning, Germany May services sector PMI came in at 47.1, recording the steepest drop in activity for 2.5 years. The Nigerian government, in collaboration with the Gates Foundation, has launched the Nigeria Artificial Intelligence Scaling Hub with a funding commitment of up to $7.5 million over 3 years. The initiative is to accelerate responsible development and large-scale deployment of AI-driven solutions across the health, agriculture, and education sectors. President Bola Tinubu yesterday conferred the national honor of Commander of the Order of the Federal Republic on Bill Gates. Gates is dedicating a major part of his fortune to improving health and education services in Africa. Asia-Pacific markets are mostly higher as South Korean stocks rise 2% to lead gains after opposition leader Lee Jae-myung wins the presidential election. Well, that's it on this edition of Global Business Insights. Thanks for watching. This is Bode Oshosami. Bye-bye.